On today's Hashi, I'm discussing the 28% jump in seller delistings, why that is, a related interview with Redfin CEO Glenn Kelman on this data, record price cuts that are happening across the country, as well as a September inflation report. Today is Tuesday, December 2, 2025. I am Byron Lazine, and the hot sheet starts now. Live from Naples, Florida, fresh out of the BAMX members only role play mastermind, which we do every single Tuesday at 9 a.m. before the hot sheet, 9 a.m. Eastern time. I see a bunch of you guys that had jumped into that role play. It was a pleasure to be with you, and it's a pleasure to be back with you right here on the hot sheet, the only live show for housing professionals on the internet every single day that the markets are open. And pleasure to be with all of you guys. I see Rochester, New York, Dawn from East Texas coming in. We got Montana in the house, so pleasure to be with all of you guys here as we navigate through the final month of 2025 in preparation for a big Q1 in 26. We only have a big Q1 if we know our information cold, if we're precise with the language that we're using, and we're passionate about helping people solve their problems. Okay, Redfin reports that there's a lot of sellers having problems today. And they're actually, speaking with their actions here. They're delisting the properties. Okay, delistings have jumped 28% now as sellers are pulling their homes off the market rather than settling for low prices. See, prices don't necessarily have to drop 20, 30, 40% because some doomer on IG says that would be better for buyers. Of course it would. It'd be a lot better for buyers if home prices were less, but it's not great for the home owner. And if they're financially stable, they're just saying, you know what? I'll keep the house. I won't sell it. I'll try again next year. I'll see where rates go, and maybe then I'll go back to the market. Home delistings are at the highest level since 2017, 84,000 plus here. A number of U.S. homes that were listed for sale and then delisted. This is September's only, okay? So this is 84,000 in September where it's like, see you later. Nope. I've seen enough. I've seen enough of this market as a seller to know that I don't want anything to do with it. I'm out on this market. Delistings in September back in 21, market was a lot different then, complete opposite. Frankly, of what we're dealing with on the macro. It was 40,000 less, down to 45,000 delistings. And some of those delistings were probably just like, I feel like I listed it too low. Maybe I'll do a cool off and then come back on at a higher price. So delistings have jumped. Glenn Kelman, Redfin CEO, looking at this data, had some comments about what is driving all of this staleness in the market, the lock-in effect, what I've been calling for years, the Cold War of real estate. Here's Glenn Kelman in a CNBC interview commenting on the staleness of the U.S. housing market.
For that long, what exactly is driving the staleness in the housing market right now?
Well, we've just had a massive shift from a seller's market to a buyer's market, the first shift in at least a decade. And everyone is just taking a moment to adjust. There are some sellers who can't sell and pay off their mortgage. That also is something we haven't heard in 10 or 15 years. And so the whole market is going through a massive transition.
Right. That is what he said at the end there. Some sellers can't sell and pay off. That is a very small segment of the market. Those are like sellers who bought in the last couple of years, last handful, 2-3 years maybe, and more so probably the last 2 years. Because if you bought in late 22 or early 23, home prices continued to rise after that. But it's the small segment of people who bought in the last couple of years and, oh, by the way, want to sell. And, oh, by the way, were stretched thin when they bought and kind of stretched to get that deal. that can't pay off the mortgage. That's not the problem that we're faced with, Glenn. But what he's talking about is this shifting dynamic that's hard for sellers to comprehend. The sellers who really do want to sell over the next 6 to 12 months, where it's like, this is not a seller's market at this time anymore. Okay, nationally speaking, you're going to have pockets in the Northeast. I get it, that are going to say, well, it's still a seller's market in this price range in the Northeast. I get it. I know it for sure. But on the macro here, we're dealing with a buyer's market, and we're dealing with something that is not only a buyer's market, but limited buyers. Okay, not huge demand. That's why transactions continue to kind of skid along 4 million existing home sales. Now, we've seen some early signs here in the second half of this year that could be improving. We look at the pendings like we did yesterday. There might be some improvement here, and we might get a little bit of a breeze. I don't think we're going to get a tailwind in 26 anymore. Kind of just looking at, the volatility still persists. And, I can't project, not that my projection will be worth anything, but I can't believe in a tailwind sweeping us off our feet here and running into some kind of a huge market upswing. Okay. We might get a breeze. We might get some improvement. Lance Lambert told us on Knowledge Brokers podcast earlier this year, like most years that don't have some dramatic economic situation attached to them, they just look like the previous year with a slight improvement. Okay. And so I think we'll get a little bit of a breeze next year, but that means we're still dealing with limited buyers. Okay. And that's where the gap between sellers' expectations and buyers' expectations, it's continuing to get wider, and it's going to take time to get centered again. Okay. How long does this last? Let's go to Glenn for his thoughts on that.
Do you have any kind of visibility on how long that transition lasts? When can we expect maybe, I guess it's all relative, but quote unquote normal behavior for, say, a spring selling season?
Well, I think it will come in the spring when the market changes over the winter. Many people decide just to pack it in, celebrate at home, put up the tree, and then try again in January, February, or March. So around the time of the Super Bowl, we'll see what direction the housing market is going to take. But until then, I think we're going to be in a limbo. There's macro uncertainty just around the whole economy. We've seen some high-end demand take a hit just because the stock market has been volatile. So people have really been worried. And when people get worried, they sometimes don't take that 30-year bet on a new home.
No, of course they would not. It makes.
Yeah. And so these are all the reasons why, if someone's going to buy over the next 6 months, they should be active and aggressive now. I see Kim in the comments, and Kim, if you want to throw Kim's comment up there, says, some sellers in my area are offering substantial reductions and concessions. Such a turn of events. We heard this in the BAMX Role Play Mastermind earlier this morning. Now, you're hearing this in a lot of different markets, not just the Texases and Floridas, but you're hearing this in even markets that have been a seller's market. I think about places in the Northeast. All of a sudden, sellers are having to concede in the negotiation or concede up front to make the deal more attractive. So there are some markets where the seasonal play is that there's just not a lot of buyers looking in December leading up to the holidays. There'll be a 2-3 week hangover after the holidays, after the new year, where people kind of get going with life again. And so we're in the hardest time here for buyer demand, which means if I'm a buyer in the next 3 to 6 months, I've got the least amount of competition right now. And if I'm smart, most people want to think that they're smart, but if I'm smart, I'm doing it when people aren't, because I'm going to get the best opportunity, the best leverage here. Okay, so what would Kelman, CEO Redfin, need to see in the coming months to get more comfortable with this market? And let's get his thoughts on that real quick.
At this point, Glenn, what exactly would you need to see in the coming months that would get you saying that maybe buyers and sellers can get more comfortable? It's easy to say interest rates have to be lower, but it maybe isn't that simple.
Well, lower interest rates will always help, especially if rates drop below 6, which is always possible. But I think the other factor is just home prices. So we have had a correction without a correction where sales volume is down as much as 50% in some markets, but prices are about the same. And so sellers are looking for some kind of indication that they aren't going to be able to get the price that they want. That is the only reason that they will invest more in repairs or drop the list price. And meanwhile, buyers think that time is on their side, that if we wait until the spring, these buyers will get a better deal. So that's why there's a standoff right now. If there's no change in home prices, but the economy remains uncertain, I think we're going to see low sales volume because sellers are going to hope for the best and buyers are going to wait for a better deal.
All right. So a lot of this is hung up on what the economy does in 2026. Obviously, DC is passionate about getting lower rates. That could help pick up the economy. Quantitative easing is something that, is very, very debatable whether they should do that or not, but that would be essentially printing money. I don't like the idea of printing money when we saw what happened with printing money, the last time, but it looks like that could be coming back into the picture. And so some of these, plays by the government essentially might speed up this recovery in 26. I still think it'll feel more like a breeze than a tailwind, but some of those things at play could impact how the market starts to move in 2026. We made it through the past 3 years. And certainly made it past the last 6 months. You're in a good position for anything that's coming. But delistings and sellers have jumped to the highest level in September, nearly 85,000, which is 28% increase year over year. That's significant. Sellers are rejecting this market. And so 5.5% of total listings nationwide delisted in September, the highest September rate in 10 years. Real estate intelligence. Before I move on from this topic, real estate intelligence. Byron, where do you find the stats and data that justifies your opposition of Glenn's claim that many owners cannot sell for enough to get out without owning with all of those fees? And so we look at this on the hot sheet. I mean, I could pull it up, or you can go into school, BAMX, and just go pull it up yourself. But you've got such a significant amount of equity across homeowners. So the sellers that have bought with the high interest rate are the ones that are in that position. But then out of that segment of sellers that have bought with the high interest rate, the ones that actually are selling, the reason why you've got 28% of people delisting as opposed to pushing forward with a sale is like, I'm not getting the number that I want in this market, and I can afford my 3-4% interest rate. I mean, this is the whole conversation of the last 3 years. I don't need a whole bunch of data to figure it out. The market's been locked up for a reason the last three to 4 years. Okay. So, I'm not going to go down a rabbit hole for the next 5 minutes searching it, but if Haley wants to find it in school, the equity reports, we go through them every single month here on the hot sheet. So if you want to target owners, I see on the next question there, you want to target people, like use PropStream or whatever to target people that have the equity, but there's a lot of people sitting on a lot of equity. And if those are the ones that you want to target, or if you want to target people that have only owned 3 to 5 years, you can do that on PropStream, either direction that you want to go there. Okay. So, delistings are up. Sellers are rejecting this market. The largest jump in delistings, Virginia Beach, Washington, DC, San Jose, Dallas, Houston, metro level declines, highest share of listings delisted, Miami, Lauderdale, Dallas, Philly, and West Palm. Lowest share of listings delisted, Pittsburgh, Milwaukee, Columbus, Cincinnati, and Chicago. Share of listings stale, 60 plus days. Florida overall has 70% of their listings are stale. They've been on the market 60 plus days. Okay. Miami, Lauderdale, Austin, West Palm, San Antonio are all up over 80% stale listings. Now, part of this is just like resetting the expectations of things don't sell in 2 weeks anymore. Hey, we're going to be signing 1-year contracts in 2026. You know, just because you were signing 3-month listing agreements doesn't mean you stick with that play. 12-month listing agreements. Take a marketing retainer if your capacity starts to run short on how many listings you can take. Protect your business. Okay. All right. Moving on from that let's move on from that and into kind of a similar story here. Zillow reporting, that there's record price cuts right now. Okay. Record discounts are rolling in. We saw Kim comment that. This is opening the window for patient buyers. All right. If I'm a buyer in the next 6 months, boy, I'm going to be aggressive over the next 6 weeks. The typical October listing was discounted by $25,000, matching a record high. If you've got old buyer leads, this is data I'm getting to them. Hey, I haven't seen deals like this since pre-2020. Okay. Typical US listing saw 25,000 in cumulative price cuts in October, largest discounts Zillow has ever recorded. So Zillow was around during the GFC, but they're seeing larger discounts now. Typical price cuts remain near 10,000, but multiple reductions are becoming more common. So multiple price drops before selling as homes take longer to sell. Most sellers have the equity to trim prices and still profit. So going to, and I know this isn't the data that I was pointing you towards inside of BAMX, but going to that previous question, Zillow says it in a sentence here, kind of in plain English. Most sellers, the opposite of what Glenn said, most sellers have the equity to trim prices and still profit. Remember, sometimes Glenn Kelman, CEO of Redfin, his opinions can be very skewed. Redfin is a very biasedly political company, that's for sure. They also are skewed towards the clientele who wants the product that is saving them the most and even reducing the services associated, less work, less comp. And people that are consumers, that's a small segment of consumers that are gravitating towards that, probably have less of a less of a margin here. But most sellers in the market today have the equity. I mean, home prices went up over almost 50%. And they're just now feeling the pain in the higher inventory markets because of the lack of buyers. If sellers just sit back and continue to delist, when the economy starts moving, the prices, you'll have realized, haven't gone down that much. Okay. If sellers start losing their jobs, different story. Relative to typical home values, the largest discounts they're seeing in Pittsburgh, New Orleans, and in Austin. Okay. We had a conversation about Austin on the BAMX Role Play Mastermind today. The smallest discounts are in affordable markets, St. Louis, Louisville, and Indianapolis, where faster sales give sellers less reason to cut their list price. Okay. It's a supply and demand game right now for sure. Here's the median price cut amounts time series. Okay. So this is pretty interesting here because you can actually toggle per location, right? If we go to Austin, which it didn't click over for me. There it is. Austin, you're actually seeing as high as 36,000. The median price cut being 33% more than the national at 15,000. And the median cumulative price cut amount is at 36,000. Why? Austin's one of those markets that has built, and built. So when Realtor.com says, hey, most affordable market in America, they talk about Austin, Texas. And if you want affordability in your market, understand that price pressure moves down. Affordability means current homeowners to sell have to reduce price because you have more supply than demand. That's how you get affordability, more supply than demand. It's not a magic pill creating affordability. It's a supply and demand game, plain and simple. If we look at Tampa, another high inventory market, so it's more similar to the country, 25,000, 10,000. We'll go to Charlotte, 24,000, so just under. Let's go to the Northeast. Boston, it's in the Northeast, but Boston being a very expensive city, we heard Glenn Kelman did say luxury taking a little bit of a hit right now. Boston, 49,000 on the median cumulative price cut amount, 25,000 on the median price cut amount. Both, even though it's a Northeast, it's a city. So both numbers substantially higher than the national average. Obviously, big price points dealing with there. Chicago, 20,000, 10,000. Denver, 30,000, 14,000. Those are both higher than the national. Hartford, Connecticut, which has been a low inventory market, seeing a shift here, 25,000, 15,000. So there you go. That'll be loaded up for you inside of school. If you want to try school out for the next 7 days, we're extending the Cyber Monday deal. You can get a free trial for the next 7 days. Go to school.com/BAMX. And you get access to every note and slide that we use here on the hot sheet. We're now into December here on the hot sheets. You have all the past hot sheets. When I reference, hey, look at some of the equity reports in the past hot sheets. They're in there. But all the slides each and every single day that we do the hot sheet, they're going to be loaded up here for you for that one-on-one communication, that one-on-one conversation that you might be having right now with a seller on what's going on. You just need to send them a text to back up some of the data, the information that you've been talking about. All of that exists right here, as well as my hot sheet show notes, exactly how we construct the show each and every single day, as well as access to the live role play masterminds like the one we had today at 9 a.m. We've got 3 more of those coming up in the month of December, as well as our content audits and all of our new courses like the hyperlocal content course that Alyssa Crenut just loaded up. This has got the most value in the industry, no question about it. Number one agent community to close more deals. If you're an agent that wants to close more deals in 2026, jump in, try it for free. School.com/BAMX. You can try it out for the next 7 days. All right. Inflation here. We got a new inflation report for September. Finally, these reports are starting to come in. Bureau of Labor Statistics reports that the PPI, the producer price index for final demand, increased 3% in September. Okay. So a little bit of old data. We're now into December, but we're playing catch up here after the government shutdown, of course. This is seasonally adjusted according to the U.S. Bureau of Labor Statistics. Final demand prices declined 0.1% in August and rose 0.8% in July. Now, a couple things just to note here. Core wholesale prices, those were moved up less than expected. Okay, so core wholesale prices moving up less than expected. That indicates like potential cooling in inflation prices. I know there's a lot of politically driven people that don't want to believe that inflation is possibly cooling on the macro in the zoom out large picture. You can take any little moment in time and pick it apart. But this is an indication that overall, yes, inflation is cooling. The PPI, this measurement we just went over from the Bureau of Labor Statistics, measure of what producers get for final demand goods and services, increased that 0.3%. That was in line with Dow Jones estimate. Okay, so I haven't said anything over estimations. Okay, so there was, when you extract food and energy, the index rose 0.1%. That was below the 0.2% estimate. Okay, so kind of overall an inflation report that didn't scare anybody. Didn't send any investors running for the hills. It's interesting though, investors, they're kind of like, I don't know if they're believing the poly market and CME Group reports this time, or they've just learned their lesson, like knowing that, okay, the Fed is probably going to cut next week, but Jerome Powell is going to come and just dump water on it. So we're not going to get ahead of ourselves. But the 10 years at 4.1. I don't know. When you see CME Group and Poly Market putting a 90% chance or a near 90% chance that the Fed's going to cut next week, what we've seen the last two meetings anyways is this momentum in the markets where the 10-year has moved down. This is the momentum we saw right before the holiday, based on the reports that, and based on those percentages on Poly Market going from 40% to near 90%, we actually saw a dip back below 4% on the 10-year. Okay, investors pricing in this cut. Now it's kind of leveled back up to 4.1. So I don't know, maybe investors are either uncertain that there will be a cut, even though these projections are awfully high, or they're just used to Jerome Powell's game where he's going to come and kind of try to dispel that cut immediately after making it in the Q&A. It's one of the two, I would imagine. 87.4% chance that the cut does happen next week, according to CME Group. And then I'll refresh Poly Market here. It's actually moved up since before the hot sheet show, 91%. 30-year fix yesterday spiked up a touch. Okay, so this was 6.31. And you're seeing that because of the increase on the 10-year there. 10-year though. So 6.31 off of a 6.22. 6.2 was the low of last week. And that's where we're sitting here today going into the rest of the day. We'll see what happens. Doesn't look like 10 years moved much this morning. We'll see where it goes here throughout the rest of the day. And we'll check back in obviously tomorrow morning back on the hot sheet. It's been a pleasure to be with you guys. I'll see you guys later on today. We'll have a new Real Word pod up here on the main channel, or I'll see you tomorrow morning on the hot sheet. Until then, of course, toodaloo.